Welcome to the Snowbirds Expat Radio Podcast. I'm Jerry Scott, founder of the Snowbirds US Day Tracker and the Canada Physical Presence Tracker app. Well, good afternoon, everybody. It's Jerry Scott here from the Snowbirds US Day Tracker. That is our major sponsor. We're being a little biased here, but it's for our Snowbirds Expat Radio Podcast. So today we're going to have a lot of fun today. The topic won't be much fun if you're an American living in Canada, but just having some fun with Gord. He is a BC Junior Hockey League alumni, and that's a junior hockey league in British Columbia. And now I'm not familiar with the Kelowna Spartans, but I wonder how many other Spartans alumni made it into the accounting world. You can fill us in.
Probably not many.
Yeah, not many. And we're not going to be prejudiced to say that hockey players, especially goalies, can't count. So, before we came on live here on the show, I was looking at your stats. So, 1990, 1991, Kelowna Spartans, BC Junior Hockey League, played 27 games, 4.13 goals against, and an 868 save percentage. And our producer will get a kick out of this because that's Toronto Maple Leaf elite percentages.
Yes. Back in the stand-up goalie days, yes.
Yeah, could have got those Maple Leafs into another further into the playoffs with an 868 save percentage. But we won't mention that your save percentage in your playoffs was 789. We'll keep that hush hush.
Tough one game, that's correct.
Yeah, exactly. Forwards blame goalies and goalies blame forwards. So there we are. But anyhow, Gord, tell me a little bit more about yourself and how does a kid from Quesnel make its way to Michigan?
Well, I was born in Quesnel, as it says, and then but really grew up in Kelowna. So I was a hometown kid playing for the hometown team there, and ended up looking for colleges to play hockey at, and found my way to Ferris State for a short period of time, and never really saw the ice, but was part of the organization there, and realized that at some point nobody was going to pay me to play hockey, but they were definitely willing to pay me to be an accountant. So I made the quick career switch, went to school, finished my career, finished my college, and now I own my own accounting firm.
Well, hockey has been a great opportunity for a lot of people. As we've mentioned before, Carson, which you know well, who works in our office and is my son-in-law, was able to play for Quesnel and Merritt, all the hotbeds of BC.
That's correct. And then the high-flying Merritt Centennials this year.
Yeah, exactly. And then he made his way to St. Louis and played and got his degree in international business. So hockey has been good to a lot of our friends. So good for you guys. So today we're going to be covering something that's really, really confusing. I always say that everything we do on this Snowbirds Expat Radio Podcast, nothing is simple and easy to understand. So our intent is to confuse people even more. And today we're going to be talking about, this is more geared towards Americans living in Canada. Canadians, they live in Canada, they're paying Canadian taxes. And as you're aware, you have to file 2 tax returns if you are an American citizen living outside of the country. So today we're going to be talking about PFIC, Passive Foreign Investment Company. And I've got 10 questions for you, and I'm sure we're going to have a lot of fun with this because this is really, really confusing for a lot of people. So the first question I have for Gordon is, what is Passive Foreign Investment Company? PFIC, what is it?
So PFIC is a non-U.S. company, or as we down here like to say, a foreign company, that has 50% of its assets owning passive investment type assets, or 75% of its income is generated, gross income is generated from passive income. So passive income is typically dividends, capital gains, interest, rent. So those types of things would generate passive income and therefore potentially make a company a PFIC for us Americans.
So why does PFIC even exist?
So people were using, Americans were using foreign companies to help shelter income. So to defer income till later times And so there was implementation of regimes to help mitigate that deferral of income so that it would be taxed back here in the U.S. U.S. is one of 2 countries in the world that tax its citizens on its worldwide income, regardless of where they live. As Canadians, if you exit Canada, and file an exit tax return, you are no longer subject to Canadian income tax. Americans don't have that same option. And so they put in these regimes in order to make sure that the American government captures all income all over the world all the time.
It's interesting. So what you kind of think the Americans are far ahead of everybody else when it comes to tax and collecting tax from their citizens. Do you ever hear of any other countries out there right now that are kind of going down that road? Countries are running these huge deficits. So
they're not really, because we are one of 2, and I can't even remember the second one. I think it's a country in Africa, possibly, that tax their citizens regardless of where they live. So it is a way of getting tax. But generally speaking, if all of your income is non-U.S., you don't end up paying any U.S. income tax. So for most Americans living in Canada, if all your income is generated there, you really don't pay tax in the U.S. Now, owning PFIC might fix that and cause you to pay tax. And there are some other circumstances, but generally speaking, if you're not invested in these type of investments, then you likely don't pay any U.S. income tax. You just have the burden of filing a return.
So who is impacted by PFIC then?
So it's generally the easiest way for somebody to be subject to these rules would be to invest in a Canadian mutual fund or a Canadian ETF. So if you do own Canadian mutual funds, then you have purchased a interest in a PFIC, and you would be required to file the forms accordingly in your U.S. tax return.
Outside of mutual funds, do a U.S. business owner who has a operating company and a holding company, could they run into PFIC issues as well?
Likely no. The operating company presumably would have gross revenue from other sources. So a construction company would have revenue from sales to its clients. A manufacturing company would have gross sales from sales to wholesalers or to retailers. Those generally would far exceed the income test. So therefore they would not be. Now, a holding company possibly could be, because there are look-through rules. And if you own a British Columbia numbered company, for instance, and it holds a bunch of investment income or generates a bunch of rent, there is a possibility that that company could be tainted by PFIC and therefore subject to these rules.
And I guess the big key takeaway here is passive.
Correct.
Okay.
Absolutely passive.
Okay.
So it's passive. So again, it's 75% of its income comes from passive sources, and 50% of its assets are invested in passive sources. And that's an OR test. So it's either or.
Okay. So when it comes to RSPs, an American has an RSP up here in Canada, and he owns a Canadian mutual fund. Are there any issues around holding that mutual fund in his RSP?
Not from a PFIC perspective. So the assets that are held in RSP, registered account, are protected, and you can virtually invest in anything you would want. But when, similar to Canada, when that money is withdrawn, that's when it's subject to income tax. But the taint of the PFIC does not get the holder. The plan itself ends up being the owner. So we don't get the PFIC problem that we would have if we owned it directly.
Okay. Now, we ask this to all our guests that are accountants and are dealing with U.S. tax, Canadian tax. How about tax-free savings accounts? Do you think it's favorable for an American to have a TFSA that lives in Canada, or are you against it?
I'm against it because if you're a Canadian citizen, Canadian resident, you get the deferral. You don't have the tax impact. By being an American citizen, the U.S. does not respect that tax-free nature in Canada. And so while you may not pay tax in Canada on that, you would definitely be subject to tax in the U.S. on its earnings.
Okay. And I guess one of the reasons is that the last time the tax treaty was revisited, tax-free savings accounts have come in after that tax treaty. And who knows, maybe that does change.
It could in the future, but who knows when they will get back to revisiting these treaties. The treaty that's in force right now was ratified in 1980, and I believe it was updated in the 1990s, in the late 90s. So clearly has some grass under the windows there. So it's getting old, and it does not account for all these modern things that have come up.
That's interesting. We talked about so many things, so many issues between Canada and the United States, maybe dairy products or forest products, but no one ever wants to talk about the treaty.
Correct.
Yeah, it's very interesting.
Yes.
Okay, so here we are. So here's a question. So we know what PFIC is. We know who's affected by PFIC. We know that it's all the forms that have to be filed with if you do have issues around PFIC. How do we avoid PFIC issues for the U.S. person living in Canada?
So the easiest way is to not invest in Canadian mutual funds. Buy American mutual funds, or buy stocks. Just straight up own stocks in the stock market. So if you were to own Bell Canada or Rogers directly, that will not be a PFIC, and so therefore you're not subject to those rules. So that if you want to invest in Canadian assets, just buy them direct.
And I guess the other thing too is a lot of the Americans that do come up to Canada that have U.S. assets, we always encourage them to use that U.S. denominated account and buy those U.S. ETFs that are trading on the U.S. exchanges. Now, how common is it that you're coming across this problem?
It's becoming more prevalent as time goes on. As more people are moving their money into the market, many investment advisors by default are putting people into these asset types and not understanding the pain that they may be inflicting on the person doing the investing, because with the IRS instructions to tax forms, they list how estimated amount of time, and the form that goes with the PFIC, they're estimating greater than 40 hours to prepare just that form to include in your tax return.
For each fund?
Each fund.
It's surprising that these, I have another life on the wealth management side, but it's really interesting to see that we in today's world, that these advisors continue to put people in Canadian mutual funds. And I think the confusion out there, maybe in defense of these advisors, is that the fund companies are coming back and saying, oh, no problem, we file a QEF. Is that what it's called, a QEF?
So there's three different regimes. One is the QEF regime, and where the fund would report data that you would need to include on the form. So yes, they can do that and to help you prepare the form, but it doesn't make it any easier.
Yeah, so maybe that's where the confusion is that the fund companies are just saying, don't worry about it. We file the reports. Yeah, you're going to be fine. And even a couple of weeks ago, we were down in Tampa, and the amount of mutual fund wholesalers are coming up to us. And obviously, they want you to invest in their products. And we keep on telling them that we are cross-border advisors. And sorry, we understand and respect PFIC, and we're not going to cause any pain to our clients whatsoever. They really do go away.
Yeah.
The wholesalers.
Yeah, I'm sure they do.
It's very interesting. It's almost like the plague. As soon as you say you're cross-border and you understand it,
exactly.
These guys do disappear. So we covered what to invest in. You're saying that it's a U.S. Individual securities on the Canadian side, or using U.S. dollars and buying ETFs on the major U.S. exchanges. And the cost for these clients to fill out, and advisors have been taught to diversify. So you're going to see 10 forms. You're going to have to fill that 8621 numerous times. What is the cost? Doesn't that eat away all the profits?
Oh, absolutely. Because for the average investor, their income from these sources is a few $100s, maybe light into low $1,000. And if you had 5 or 6 funds, it could easily be $200 or more per form. So you're looking at $1,000 plus if you had 5 forms in order to complete that. And that's assuming that the person doing the U.S. return understands these rules. And if they don't, and you don't include that, now you're subject to penalties that could start at $10,000.
Now, we've heard some advisors or some accountants out there that are saying, don't worry about it. Don't worry about filing it. Do you see that? Or
I do see that. And my first recommendation to people is just get out. Get rid of the asset, sell it, and get into something that is more appropriate so that you don't have this issue. Because the cost, whether it's penalties from the U.S. government or the filing fees or the tax, are going to far outweigh any benefit you're reaping from investing in these securities.
Now, when you're having a conversation with the clients that you're filing tax returns, do you get calls from the advisors, and is there a little bit of pushback, or do you ever see that, or are they pretty?
They're usually insulated from me. They don't know about me being on the U.S. side and pushing back. It's usually the client themselves that is stuck in the middle to deal with this.
Yeah, I could see that. That becomes a bit of a real problem, because advisors just don't seem to get it or understand the PFIC. So we know that it's expensive. You're telling them to avoid it. Now, what are some other things outside of PFIC? What is the most common problem that you're seeing out there with these Americans living in Canada, filing their tax returns?
So the two most common things that come up are FBAR filings, and there's a form called 8938, which is similar to the FBAR. So if a U.S. person, so U.S. citizen, U.S. green card holder, or Canadian citizen that's resident in the U.S., holds accounts in Canada or elsewhere in the world, that have more than $10,000 US cumulative in them, they are required to file an FBAR. And that is based on the highest balance of the year. So if you sold something in Canada and brought the money back 3 days later, and that balance spiked over that $10,000 mark, they would be required to file it's Form 114. We call it FBAR, for Foreign Bank Account Reporting, with FinCEN. It's not an IRS filing, goes at the similar time, but it's filed with the Financial Crime Center, actually, in the U.S. On an annual basis. The Form 8938 is its counterpart, and that does go to the IRS, and it starts, depending on the person and how they file in the U.S., but it starts with a balances in excess of $50,000. And so quite often those get missed.
Now, even their RSPs have to go on that FBAR report as well?
Correct. That is a foreign asset, so they are included in the balance. Now, there is no tax on either one of those forms. It's information reporting only, but failure to report them can cause penalties.
Okay. Now, we touch base about an American living in Canada having to file a tax return. And of course, it's just federal tax they have to worry about when they're in Canada. What about all these Canadians that are moving down south and are coming to you for tax strategies and different things?
Sure.
What are some of the things that those people should be worried about?
First off is becoming a U.S. resident accidentally. So there's two numbers, I guess one real number that they've got to be concerned about. If you're in the U.S. for more than 182 days, then you would likely become a U.S. resident, therefore subject to all of these rules that we've been talking about, because you would have to file a U.S. income tax return here. And that would also include all of your Canadian earnings. So from anything, wages, whatever, would be subject to tax down here in the U.S. So there's a couple ways around that. One is the easiest one, make sure you're counting your days so that you stay below the 182 days. There's also a look back calculation that you've got to be cautious of, which starts with 100% of the days in the current year, plus one third of the days in the first prior year, and 1/6 of the days from 2 years ago. So when you do that computation and say you were only here for 60 days this year, but when you start doing the math with the other ones, now you end up at 185, you may be subject to U.S. income tax as a resident again. So that one is easily missed for people who spend significant amount of time down in Florida or Arizona, California, that they just aren't aware of.
And that's why we created the Snowbird US Day Tracker app.
Correct.
For that reason alone. Now, you talk about the 182 days in a calendar year. Now, what happens if someone just goes down to the United States? And you're right, as long as they avoid the 182 in that calendar year. But now there's a lot of confusion around 182 on a trailing, it's a 12-month rolling calendar.
Rolling 12, yeah.
So that's what you're saying. It's 182 in a rolling 12.
No. So there's a lot of confusion, especially with businesses. So as an individual, for U.S. income tax purposes, 182 is a strict calendar computation, January 1, December 31. Now, if you own a business, and the business, what we call is permanent establishment, which means that it is somehow set up some type of presence here in the U.S., the treaty allows for a similar 182, but that is on a rolling 12. So that business may be subject to U.S. income tax if on a rolling 12, it creeps over the 182-day mark.
And that is a business that's established in the United States?
No, it could be a business established in Canada.
Okay.
So a Canadian corporation has their owner spend significant amount of time in here working. So they're down here going to trade shows, visiting customers, that type of thing, and could potentially spend more than the 182 days down in the U.S. And therefore, the business then may be subject to permanent establishment and be required to file an 1120-F here in the U.S.
So the average person, and this is the thing that we're getting question about all the time. We need to put a 12-month rolling calendar on our app. And for the average person that's retired, who's just spending time in the States, should not have to worry about that 12-month rolling calendar.
Correct. Just the pure regular calendar, not a rolling.
That's something. Well, I think a lot of people are going to be happy to hear that because, and like you say, if they are receiving income, if they have taxable income and they're in the States for more than 182 days, well, then they got some issues if they're still technically working.
Yeah, and if the average person now, if they're spending, like my aunt spends 181 or 182 days a year in Arizona, she needs to file the closer connection form. Because if you do the look back calculation, even though she's under 182 or 183 for this year, when you do the computation, she's going to be way over. So if you file, I believe it's 8840, the closer connection form, which basically says, okay, I may be subject to tax in both countries, but when you look at my centers of banking, my centers of influence, where my family lives, where my assets are, I'm a Canadian citizen. I'm a Canadian resident, so therefore I am not subject to tax in the U.S. And you can file that form standalone, not connected to a U.S. income tax return, and that would give you the protection, assuming you're under the 182 days or less, that you would need in order to maintain your non-resident status in the U.S.
Well, the app we have allows you to download the app, the actual form, the 8840. Once you've done the calculations, and once you've exceeded that 183. We really encourage people to follow the 8840. And like you say, it's just a simple form. The answers are Canada, 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 Canada. You fill it out, you send it to, I think it's Austin, Texas, I believe that gets sent to.
That's correct. Yep.
And that's all you have to do. And we've been filling out the 8840 for years because of our time going back and forth to the States as well. Well, I have to say that you really helped us out with that. I know we talked about PFIC and we all have all the problems, and you and I we're communicating quite often with clients going back and forth and dealing with this PFIC issue. We do have a solution for it. Don't do it.
Correct.
Avoid it. Simple.
Yes.
We could have summed that up in 2 seconds. But the other thing that I thought was really interesting is how you explained that 12-month rolling calendar, and it does not exist for the average person who's spending time in the States, providing they are less than 182 days in any one calendar year.
Correct.
Yeah, that's going to be that's fun to that's going to be fun to get that point across out to everybody. Well, Gordon, I really want to thank you for your time today. I want to bug you more. I was the farthest I got in hockey was playing floor hockey goalie in Ucluelet. It wasn't a hotbed for NHL prospects by no means. It's a great position. So I'm sure as we do more podcasts with yourself, there'll be a lot of badger going back and forth about our careers. So
Absolutely.
I really appreciate what you do for our clients, and
No problem.
And
Can I say, if people want to get a hold of me, can I give you my website?
You sure can.
So it's the easiest website for everybody would be ustaxprep.ca. And that will take you to our website for Dale and Associates, and there's some information there, and some basic information, but our phone number's there. You can give us a call, and we'll be able to answer whatever we can. So it's ustaxprep.ca.
Yeah, and what we're going to be doing is that we're just going through a process of having the Snowbirds US Day Tracker app, the website all refreshed, and you'll see our partners on there. So Gordon will be, you'll be accessible from there, one click away, and you can talk to this famous Kelowna Spartans alumni goaltender, and he'll be able to help you with your taxes. So on that note, I really appreciate what you do for our clients, and thank you for all the referrals you sent us. So you have a wonderful afternoon, and we look forward to talking soon.
Sounds good. Thanks, Jerry.
Thank you for listening to the Snowbirds Expat Radio Podcast. Our app is available for your iPhone and your Android. If you have any questions, call me 604-612-7526. Until our next podcast, I'm Jerry Scott.